Hello, Dave from Solidaire here again. Welcome to the first video on corporate finance. Today we are going to focus on general information that will be useful in the next videos. In this video, we are going to explain the process of capital budgeting and the steps it involves and its main principles. We are going to say what an investment project is. Additionally, we are going to distinguish between different types of investment projects and introduce a few definitions. Off we go then. Let's start with the concept of budgeting. Budgeting is a process carried out by companies in order to make decisions on investment projects lasting more than 1 year. It is a key issue for in-house analysts because potential mistakes made during the budgeting process may affect the future of their companies. So remember, if you think about budgeting, you automatically think about analysis of investment projects which last longer than 1 year. Budgeting can be divided into 4 steps. Step 1. Generating ideas. Step 2. Analysing individual proposals. Step 3. Planning the capital budget. Step 4. Monitoring and post-auditing. The step called generating ideas is the most important part of the budgeting process. At this stage, ideas for future investment projects are born. These ideas come from each department of the company, but they can also come from the outside. The next step, called analysing individual proposals, is about gathering information in order to estimate future cash flows and assess the profitability of individual projects. The third step, that is planning the capital budget, involves choosing profitable projects so that they fit the company's strategy. In a nutshell, at this stage, you choose those of the identified profitable projects which are good for your business. Note that even though some projects analysed individually may be assessed as profitable, if we consider the company as a whole, they may be unsuitable. In the monitoring and post-auditing step, which is the last stage of the budgeting process, you compare the actual results of investments with the planned or predicted results, and you may explain any differences. You could ask, why should I compare actual results with forecasts if I can't change anything now anyway? Well, you can't change anything in relation to that particular project, but you can learn lessons for the future. Ex post audit allows you to monitor the forecasts and analyses that underlie the capital budgeting process and improve company performance. It also allows you to respond if sales or costs are out of line. So, to sum up, the budgeting process should consist of 4 steps. The most important one is the first step, when you come up with ideas for investments that are to increase the value of the company. As a result of the budgeting process, you choose those investment projects whose implementation will contribute to the ultimate goal of the management, which is to increase the value of a company for its owners, for example, stockholders in the case of a public company. What kinds of investment projects are there? There are different classifications of projects. One such classification would be as follows. 1. Replacement projects. 2. Expansion projects. 3. New products and services. 4. Regulatory, safety and environmental projects. 5. High-risk projects that are not subject to traditional evaluation methods, such as the net present value or the so-called PET projects. Replacement projects are simple and they don't require any difficult financial decisions. They involve replacing damaged or outdated or inefficient equipment. Replacing equipment that has simply broken down is straightforward. Choosing newer, more efficient equipment to replace the existing requires some more in-depth analysis. Expansion projects help to increase the size of the business. They are characterized by greater uncertainty than replacement projects and should be handled with greater care. Investments associated with new products and services require even more attention and are more complex than expansion projects. Regulatory, safety, and environmental projects frequently required by governmental agencies and other such institutions are the next category of projects. Generally, they don't generate profits and therefore are rejected by companies seeking to maximize their own interests. The last group includes projects that cannot be analysed using the net present value. These include all projects carrying too much risk to analyse them using traditional methods and the so-called PET projects. Before we get to the main principles of budgeting, I'm going to explain the following concepts: a sunk cost, opportunity costs, an incremental cash flow, externalities, conventional and non-conventional projects. A sunk cost is the cost that has been incurred that can't be changed. Today's decisions shouldn't be based on costs incurred earlier, that is, sunk costs. An opportunity cost is an incurred cost and a result of a particular choice. It shows you the benefit that would be achieved if you choose a different solution. If you replace an old machine with a new one, an opportunity cost is 1. Cash flow generated by the machine which you got rid of, and 2. Any possible profits from the investment of additional money dedicated for the purchase of a new machine. Remember that when you analyse an opportunity cost, you should always take into consideration market values. The same rule applies to the weighted average cost of capital, but we are going to talk about that some other time. An incremental cash flow is equal to the difference between the cash flow if we undertake the project and the cash flow if we don't undertake the project. Externalities are factors that influence an investment and which are not directly related to the project. They can be both positive and negative, and they can come from the same company or from outside. One example of externality can be cannibalization, a situation in which the benefits of investment projects adversely affect revenues from other activities of the company. A conventional cash flow pattern is one with an initial outflow followed by a series of inflows. In the case of non-conventional cash flow patterns, outflows appear more than once and are interwoven with inflows. Obviously, it's easier to analyse and evaluate projects with conventional cash flow patterns. In general, computation problems on Level 1 exam will cover such projects, which doesn't mean that you shouldn't know what the non-conventional projects are. Let's now think what principles you follow during the budgeting process. Firstly, investment planning is time-consuming. It requires the participation of many people from both inside and outside the company. Investment decisions should lead to a situation in which investment profits are higher than the investment costs. Only then will the value of the company increase. In general, you can imagine a company as a set of projects. Undoubtedly, if those in charge of the company add new projects to this already existing set, they would like to increase the total value of the business. But let's go back now, specifically to the principles of budgeting. We can distinguish several universal principles on which the evaluation of investment projects is based. These principles apply to cash flows and the discount rate. In short, in order to evaluate investment projects, you use after-tax operating cash flows, which you place at certain moments in time, and you discount them at the interest rate, which takes into account capital costs and financing costs. If you wanted to develop this further, you should remember that 1. All decisions are based on cash flows rather than income statements accounts, such as net income. 2. A very important factor is the right placement of cash flows over time, because whether the project is profitable or not depends on it. 3. Cash flows are considered in the context of opportunity costs. Incremental cash flows achieved through an investment are compared with cash flows that would occur without undertaking the investment. 4. After-tax cash flows are analysed. Taxes must be considered when making any investment decisions. 5. Financing costs are not reflected in cash flows but in the required rate of return. Therefore, we take into account cash flows from operating activities and the discount rate includes financing costs. Finally, we are going to introduce one more division of investment projects and say a few words about project sequencing and the availability of capital. According to an independence criterion, projects can be divided into independent projects and mutually exclusive projects. In the case of independent projects, cash flows of individual projects aren't dependent on each other and projects can be carried out simultaneously. When it comes to mutually exclusive projects, it isn't possible to simultaneously carry out different projects. You have to choose one of them or reject all. Project sequencing is when many projects are sequenced through time, so it is possible to invest in them at different times. Therefore, you might invest in a project today and after some time invest in another project if the financial results of the first project are desirable. If a company has unlimited funds, it can carry out all the projects that provide the required rate of return. In the case of limited funds and capital rationing, the company should choose those projects that maximize company value. The presence of mutually exclusive projects, project sequencing, and capital rationing makes a good budgeting process difficult. That's all as far as the first video on corporate finance is concerned. In the next video, we're going to talk about investment criteria such as NPV or IRR. Bye!